So this video we call our income funnel and tax bracket management. When it comes to planning for taxes and understanding the different tax strategies that you want to implement and put in place, you got to understand how that affects not just the cash flow to income, which is what the income funnel will show, but also how do we manage the tax bracket to be able to get the best results we can from the reduction of income due to our our tax planning, our planning for taxes. And there's a misnomer when most clients ask their CPA, hey, what is my tax rate? There's a misnomer to that. And we're going to talk about that right now, and then we'll dive into the actual real savings of how the income and how the tax brackets work from a tax savings perspective. So here's a federal 2020 federal tax return, and so obviously we removed all the information other than the numbers, and we want to highlight a few things. So let's take a look at total income. Total income is $522,000. Okay. Now, if you look at adjusted gross income just below it right here, it's 522 as well. So there's really no adjustments. So that's why we're highlighting 522. Now, the total income and the taxable income are different. And so what we want to look at is our total tax. Our total tax on this particular client, if you were to take 94,820 divided by the 522,093, they're right in about an 18% tax bracket. Now, you have to have all your credits, you have to all these other things, so their taxable income truly is right here. I'm going to grab my pen here. Their taxable income is right here, 416. Okay, so now if you took the total tax, the 94,820 divided by the 416,147, it would give you your effective tax rate. And this is the issue that I have when it comes to asking CPAs, hey, what's my tax rate? CPAs, what are they going to do? They're going to talk about your effective. But really, the marginal tax rate, where the client's tax rate is based on their income, is in the 35%. Okay. Now, when it comes to tax planning, it does affect your adjustments to income, because as a business owner, part of your adjustments is your qualified business income as well as your personal itemized deductions. Okay, so in my example, I'm going to use the 522 because it's a truer number than the adjusted gross income. Okay, right now it shows what it is, but what we want to do is kind of dive into here. See the taxable income. Look at qualified business income deduction. You have your itemized, and so those affect the taxable income. So I want to eliminate those and look at the true tax savings to this. Okay, so what's this going to look like? So the first thing we need to understand, if you haven't seen our income funnel explanation already, let's go ahead and go through here. So our income is 522. Now we have a saying in our firm, income is taxable, cash flow is plannable. Okay, and so as a business owner, this is a very important distinction in understanding, because when you have income, it goes down the income funnel. So whether it's wages, 1099, K1, or real estate, and it summarizes on your 1040. It doesn't become income until you activate it, or you acknowledge it, or you qualify the cash flow as income. So in these situations, wages, salaries, 1099, or K1 profit from your business. Okay. Now, when we look at our tax savings formula, we take the 522, and let's say the client only needs about $320 a year in income. Okay, because of their personal lifestyle and expenses. When you subtract that from the 522, the reality is that they only need they have 202,000 of extra income that's flowing down this funnel that should stay as cash flow on the top of the funnel. They don't need this. So where would this 202 come from? Well, right off the bat, when we're looking at the numbers, it can be subtracted from the 287 of profit. Okay, and so, well, that means they're not getting as much profit. They're getting the profit they need, the 320, for their lifestyle. We got to understand that. If you allow all of your assets to generate cash flow, and that cash flow you allow to summarize on your 1040, you're allowing it to be taxable, and you're paying yourself taxes on that. Okay, you have the ability not to do that. And so that's what we're going to do. Is this 202, we're going to show how we shift it and leave it at the top of the income funnel as cash flow. Okay, and so what we need to understand is this cash flow we recovered 202 from tax savings. I mean, from taxes. So let's take a look at this, how the income funnel looks from a tax bracket perspective. So what we did was we looked at the very bottom of the bracket is your 10%. You're going to have to pay this. And so the way it is it progressively, let me get my pen here, it progressively goes up based on how much income you have. It's called the progressive tax system or a progressive tax bracket. Okay. Now, the less money you have or the more money you save, you go down the bracket, the funnel, and you're saving on the top percentage. You're not saving at the bottom percentage. So when you ask your tax professional, your CPA, hey, what's my tax rate? They tell you the effective. They're including the 10%. They're including the 12%. They're including the 22% with your 35%, your 32%. Okay? But that's not where the savings comes from. The saving comes from the top, and when you redo tax planning, we're reducing your income to where we're dropping and your tax savings is on the higher percentage. Okay? Now, this is a very important distinction because this is how we manage our brackets. So let's take a look. In our client situation, we have $522,000 of income. He's in a 35% tax bracket. So between $414,000 and $622, that's the 35% tax bracket. So that's what each of these blue lines represent, is the income that is qualified in that. Now, when we bring his income down to $320, we bring him from the 35% tax bracket down to the 24. Now look at the $320. Okay, he just squeaks in at the 24% tax bracket. So that means the majority of his tax savings in our planning is at a 35 and a 32% tax rate. Let's take a look at what that looks like. Okay, so when we take his 522 and subtract it from the 414, that's $107,000 that is not being taxed at 35%, or $37,555,000 tax savings. Then we go down to the next bracket. So his 414, 700,000 to the 326. So this entire bracket he's saving, and that's $88,099, and that's a total tax savings of $28,192. Okay, and the last part of it is the 6,600. So 326, 600 minus the 320 leaves $666. $6,600, sorry, and at a 24% tax rate, that's a savings of $1,584. You add it all up, that 202 in savings, income savings, is a tax savings of $67,000 for a tax savings of 33.3%. Okay, this is very important distinction. If we looked at this, and most CPAs, what they would end up doing is taking your effective rate, not your marginal rate. Okay, and so this is important to understand. So when you ask, hey, what's my tax rate? Oh, it's 22.8%. No, because what you're asking is, where can I save? Because it's including these lower incomes or these lower tax to give you your quote unquote effective. So you're not at a 22.8% tax bracket, you're at a 35% tax bracket because you're paying taxes on that. And that we showed you a 37% tax savings. So this overall is what we're trying to strive for in a tax planning, and we're trying to reduce that by utilizing different tax strategies. Hopefully this was helpful.